Warren Buffett, a name synonymous with disciplined investing, decades of wisdom, and a playbook that many have tried and failed to replicate, has just made a move that has Wall Street buzzing with unease. It's not every day that Buffett breaks one of his own ironclad rules, the kind of rules that have guided him through bull markets, bear markets, and everything in between. So why is this sudden departure causing such a stir? What exactly did Buffett do, and what does it mean for investors, both big and small? Today, we're diving deep into this unexpected twist, unraveling the layers behind Buffett's decision, and exploring why the financial world is suddenly on edge. For decades, Warren Buffett has preached the gospel of patience, value investing, and sticking to businesses he understands deeply. His approach has been methodical, almost ritualistic. He avoids tech fads, shuns flashy IPOs, and has famously said that the best holding period for a stock is forever. His portfolio is a testament to this discipline, loaded with companies that generate steady cash flows, enjoy durable competitive advantages, and are managed by capable leaders. Investors look up to Buffett as the Oracle of Omaha because he has proven time and again that success in the market isn't about quick wins, but about playing the long game wisely. But what happens when the Oracle himself shakes things up? What if he suddenly buys into something he's always avoided, or sells a stalwart holding he's clung to for years? That's exactly what's happening now, and it's raising eyebrows. The nature of Buffett's investment style is such that any deviation from his norms is not just a minor footnote. It's a headline. People start asking, if Buffett's changing his tune, what does that say about the market? Is it a signal of an impending shift? Or is he reacting to some hidden insight we don't yet understand? To understand the significance of this move, it's important to look back at the principles Warren Buffett has laid out over his lifetime. One of his core tenets has been to avoid businesses and sectors he doesn't fully grasp, what he famously calls staying within his circle of competence. This means that even when tech stocks or trendy sectors boom, Buffett has been cautious, often opting out because he finds them too complex or too volatile. He's also avoided excessive diversification, focusing instead on a handful of high-conviction bets. So, when reports surfaced that Buffett was acquiring stakes in companies outside his usual domain, or doing so in a manner that contradicted his previous caution, it wasn't just a curiosity, it was a shock. But let's step back and consider the bigger picture. The world of investing has evolved dramatically, especially in the last decade. Technology is reshaping industries at breakneck speed. Market dynamics have changed with the rise of algorithmic trading, unprecedented monetary policies, and the entry of retail investors wielding more influence than ever before. Even Buffett, with all his wisdom, is not immune to these changes. Could this new move reflect a strategic adaptation to the modern market landscape? Or is it a sign of growing uncertainty, prompting Buffett to hedge his bets in new ways? This is what makes this moment so compelling. We're witnessing a master investor, someone whose approach has been studied and revered, making a choice that goes against the grain of his established philosophy. For everyday investors, this raises vital questions. Should we rethink our own investment strategies? Is it time to embrace sectors or approaches previously avoided? Or is Buffett's move a one-off, a tactical adjustment rather than a fundamental shift? Throughout this video, we'll break down the specifics of Buffett's recent decision, what he bought or sold, why it's unusual, and what experts are saying. We'll analyze the possible reasons behind this break from tradition and the risks and opportunities it presents. More importantly, we'll discuss what this could mean for the broader market and for you as an investor. Before we get too deep into the details, consider this: investing is never static. Even the most successful strategies must evolve with changing circumstances. Buffett's willingness to step outside his usual boundaries might be a masterclass in adaptation, or it could be a warning sign of turbulence ahead. Either way, it's an invaluable moment to learn from the man who's made more money in the markets than almost anyone else in history. Right now, if you find this kind of inside look at Buffett's moves and market insights interesting, make sure to hit that subscribe button. We're diving into the heart of what makes investing tick and breaking down moves that impact millions of dollars and millions of people. Also, drop your thoughts in the comments below. Do you think Buffett's breaking his own rule is a smart pivot or a risky gamble? Your opinion matters, and this community thrives on hearing different perspectives. Now, let's get into the nuts and bolts of this story. Warren Buffett's recent action involves a departure from his well-known aversion to fast-changing sectors. For years, he stayed clear of tech stocks, claiming he doesn't understand their business models well enough to predict their futures accurately. Yet, his latest move includes a significant purchase in a tech company that, until recently, he publicly dismissed. This has sent shockwaves through Wall Street, where investors scramble to interpret what this means. One possible explanation is that Buffett sees an inflection point in this company or sector, where previous risks have been mitigated and sustainable value is emerging. Or maybe he's reacting to broader economic shifts, such as rising interest rates, inflation concerns, or geopolitical tensions that require a more diversified portfolio to protect against downside risks. Some analysts suggest this move is a signal that Buffett believes the traditional sectors he favors, finance, insurance, consumer goods, may face headwinds ahead. By stepping into a new area, he's hedging his exposure to possible declines in those industries. Others think it's simply a rare moment of opportunism, a chance to buy into a company at a discount after a market correction or a temporary crisis. But beyond the tactical reasons, there's a philosophical element. Buffett's core strategy has always emphasized understanding what you invest in. So, buying into a sector he previously avoided might indicate he now believes the business models have matured or become more predictable. Perhaps the company's leadership has changed, or new regulations have stabilized the market environment. It's also worth noting that Buffett manages his investments not only for profit but with an eye on long-term sustainability. That means he's less interested in short-term market hype and more focused on enduring value. So, even if this move seems out of character, it's likely rooted in careful analysis and a deep conviction that the risk is justified. For investors watching closely, this moment is both a warning and an opportunity. It's a warning because even the best investors must recalibrate their views as markets evolve. Holding on blindly to old rules can lead to missed opportunities or unexpected losses. But it's also an opportunity, because understanding why Buffett changed his stance can reveal new investment themes and strategies worth considering. As you reflect on all this, think about your own investment approach. Are you holding on to outdated beliefs because they've worked in the past? Or are you adapting to the current environment? Buffett's move challenges us all to stay curious, open-minded, and willing to rethink what we thought we knew. If you've found value in this analysis so far, don't forget to subscribe to the channel for more insights like this. We break down complex financial moves and make them understandable and actionable. Also, leave a comment sharing your take. What do you think Buffett's move means for the future? Are you planning to adjust your portfolio based on this news? Now, let's examine some of the concrete data behind this story. The company Buffett invested in recently saw its stock price decline significantly over the past year due to regulatory concerns and shifting market sentiment. Traditionally, Buffett would avoid a company in turmoil like this. Yet, his Berkshire Hathaway took a substantial position, signaling confidence in the company's ability to recover and thrive long-term. Looking at historical patterns, Buffett has made similar contrarian moves before, buying during downturns when others flee. But this time, the stakes feel higher because it involves a sector he historically avoided entirely. This raises the question, is Buffett recognizing a new era where technology and traditional industries are increasingly intertwined? Does this investment reflect a belief that diversification across sectors, including tech, is essential for portfolio resilience? We also need to consider the macroeconomic backdrop. Inflation pressures, supply chain disruptions, and global geopolitical uncertainty are creating unpredictable market conditions. Buffett's move could be a preemptive shift to position his portfolio for these challenges, balancing his traditional holdings with growth opportunities in tech. Additionally, the leadership of the company Buffett invested in recently announced strategic changes, including renewed focus on profitability and operational efficiency. This might have persuaded Buffett that the risk-reward balance now favors an investment. After all, Buffett doesn't just invest in companies. He invests in management teams he trusts to execute long-term strategies. Wall Street's nervousness is understandable. When Buffett steps into unfamiliar territory, it sends ripples across the market. Investors start questioning whether their own portfolios are aligned with this new thinking. Will tech stocks continue to rise? Are traditional value stocks losing their luster? The uncertainty is palpable, but it also opens the door for new strategies and opportunities. For everyday investors, the takeaway isn't to blindly copy Buffett, but to understand the principles behind his moves. Look for businesses with durable competitive advantages, capable management, and reasonable valuations. Be willing to reassess your assumptions in light of new information, but don't chase trends without a solid foundation. In conclusion, Warren Buffett breaking his own rule is more than just a headline. It's a lesson in adaptability, risk assessment, and the evolving nature of investing. Markets change, and even legends must adjust. For you, the viewer, this moment is a chance to learn from Buffett's decision-making process, to think critically about your own approach, and to stay flexible in an unpredictable market. If you enjoyed this deep dive into Buffett's unexpected move, check out our next video where we explore the rise of tech investing and how it's reshaping traditional portfolios. Trust me, if you thought this was surprising, wait until you see what's happening next in the investment world. Don't forget to like the video if it helped you, subscribe for more content like this,